Hello and welcome. Yeah, but the audio's going to go down when it starts.
I know, man. I'm not even commenting on it.
10 weeks in, I think. We're still trying to work out how to turn the audio down at the right time. Hello and welcome.
To be fair, what's happening? I'm getting excited by the dancing. I'm like, I love this banger.
You get lost
Let's
in the
go.
boog. You get lost in the boogie.
Lost in the book.
You get lost in the boog. So, I know, Beck, so close this time. We almost got it. I thought I'd jump in on cue, but then I was just like, Gabby was mid-rave. We just couldn't get it going. All right, anyway, let's go. Hello and welcome. You're joining us live on the Investor Lab at the auditory and visual epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose.
My name's Gabby. And I cooked the fade out then. Anyway, nobody else is noticing. Go, carry on. Carry on.
Which one of us studied audio engineering?
It wasn't you.
It wasn't me.
Hi, team.
Hang on a second.
Hello.
Hang on a second. 3CAR just said breaking.
Holy
President's
shit.
Executive disorder. All right, I'm going to do a little bit of looking at that.
Like
Gabby,
right
why don't
now?
you let me do some fact checking on that.
Okay,
whilst
bye.
you do
See
an
ya.
introduction. No, do a bit of an introduction to the episode. Let's go.
Yeah, awesome. So, hi guys, welcome. Today we are digging into hurdle rates because really what I want to do with this episode is I've got a bit of a mission to cure FOMO. Or maybe not cure FOMO, but help prevent FOMO, because a lot of investors in whatever asset class you want to invest in, we get caught in this sense of I should be doing better, or somebody else is doing better than me, or somebody else is investing in another asset and I should be doing that and I should jump across to that. And really, as an investor, a really strong way to start for yourself is setting this thesis of what am I setting out to achieve? What is the minimum return that I feel comfortable and I would be happy with if this investment returned me in 1 year? And setting that for yourself as you are approaching asset selection and capital allocation is a really, really crucial place to start, because it's just going to help you to stay sane effectively. It helps you to bring this context of, I know what I'm setting out for. I'm not going to get caught in everything else. There's going to be amazing opportunities. Somebody else out there is always going to get a better return than whatever you get. It always exists. And so how can we approach this in a way that I actually know that I'm winning, not comparing myself to everyone else? Goose, are you back?
I'm back. I think it's a great setup. Just a quick one. Blake said I just want to check our voices are really low. Can you let us know in the chat if our audio is okay? We did do an audio check beforehand. We do just want to make sure that it is. So let us know if the audio is suitable or not. If it needs to go up, we can fix that. Just let us know. Yeah. So I think it's a really great setup, Gabby, and I think it's a couple of really key points to that, because the first point of reference to that is comparison is the thief of joy. And if you just go out in a pursuit of, I want to make money, let's just say, like just some kind of like very brash and crass kind of objective. I want to make more money. Well, compared to what? And how much is more money? And how high is up? And there's always going to be someone who's richer than you. There's always going to be someone who's made bigger gains than you. There's always going to be someone who has, who appears on the surface has done more than you in less time or something like that. And so you end up, if you're not careful, you end up entering into an unwinnable game. And that game actually ends up making you feel bad and making your life worse, when in fact, you actually might be doing swimmingly. You might be going just absolutely fantastic. And you're always going to miss opportunities, right? And it's something you just need to accept. So if your point of reference is not appropriately placed, then you will always continue to measure yourself against someone who is better than you. So therefore, you will always continue to think that you are doing worse than you are, which is not ideal. And that's why comparison is the thief of joy. And so then the question is, well, okay, if I'm not going to compare myself to others, how can I compare myself against myself? And then how would I establish what is an appropriate metric? Okay, so and you can do this in all areas of life. In this context, we're gonna do it around specifically investing, but understanding what does winning look like for you, and on what terms and in what way is the most important thing. Because what is absolutely true is that investing carries risk. Investing carries stress. Prices can go up, prices can go down. Now, real estate tends to be less volatile, so you tend to experience less scenarios where prices go down, so you have less of those kind of heart-wrenching moments, but it does happen. It does happen. So, I spoke to a couple just yesterday, and they bought a property at the peak of the market. So they bought a property in 2017 for $700,000. And they 2015, I think it was, for $700,000, and they sold it like just a couple of months ago, so we'll call it 10 years later, for $760,000. Now, in real terms, they've lost money. Like in very real terms, they've lost money. It went up by less than 10% in 10 years. And so understanding like how you are measuring is really, really important. Now, the way that I think about hurdle rates is I think about, okay, what am I trying to beat? Am I trying to beat Johnny Magoo down the road? Am I trying to beat some bloke that I saw on the internet? Because by the way, there's always going to be someone on the internet that's made
some bloke on the internet.
Yeah, they've made $100 million in 10 hours, doing some crazy thing. And yeah, go on.
Sorry, no, I was just like, to be fair, we are some blokes on the internet right now. We forget that. Yeah.
We are some blokes on the internet. We are also getting told to turn our audio up a little bit as well. So
let's
have a little look at that. We'll just crank it up. I'm going to go up to 40. I'm going up to 45 on StreamYard. See if that's 46. We're going 48. We're going to 48.
Wow. Cooking.
See how that works. So you head up to
guys, the main issue we have, just community, please help, but it's the balance between both of our audio levels, because we can't actually. He sounds fine to me, but he might be quiet to you guys. So if we are different, let us know. But I'll turn mine up as well a little. Carry on.
Our only commitment is that we're going to continue to try and get better every week. So thanks for persisting with us.
Always audio.
It's always audio. So there's always going to be some person on the internet who's made $100 bajillion in 10 minutes, doing some kind of crazy thing. Now, if you listen to all of that kind of stuff, and if you get distracted, what that can actually lead you to is to get substandard returns, because what that will lead you to do is to jump strategies. Can lead you to chase after other things before you've actually fully realized the opportunity that you've got at hand. And it can cause you to not go deep enough on the things you should go deep on. And it can cause you to spread yourself too thin. So if you're not going to compare yourself to others, how do you compare yourself against yourself, and what's an appropriate benchmark? And so what I might do now, Gabby, is actually kind of go into how I think about hurdle rates and how I think about the establishment of hurdle rates. And do you think it's a good jump?
Yeah, great. Yeah, it's just before you do that, we've been debating this all week, to be fair, because I'm very practical. You're also practical, but I'm trying to make this really tangible for people. And I'm like, well, there's a formula, and let's create a formula, and it goes this bit. And you're like, yeah, it depends though. There are elements, all of these elements, I think you can like add together to get your hurdle rate, but there is element of, it depends on what you're trying to achieve, right? There is some variability. Yeah.
Yeah, exactly. And so now a simple way to think about this is, what's your benchmark? Now, a hedge fund, for example, might have a benchmark that says, we're going to outperform the S&P 500, and that's going to be our benchmark. Okay. And so what they would say to their investors is something like, give us your money. We'll charge you a 2% management fee. And our benchmark is going to be the S&P 500. So whatever the S&P 500 does in that year, right, or that quarter, or whatever the measurement period is, we're going to beat that. That's our benchmark. And if we beat it, we also want 20% of the upside. So it's typically a 2 and 20 model, but they pick the benchmark. Now, different funds may have different benchmarks. So, for example, instead of the S&P 500, maybe the benchmark is going to be the MSCI, Emerging Markets Index, or perhaps it's going to be some kind of REIT that you'll be benchmarking against, or some other metric. And so, choosing your benchmark is really important. Choosing your benchmark is important. And this is actually kind of the fundamental piece to establishing your hurdle rate, is deciding what your benchmark is. Now, I'll give you a little story here. I'm going to have a few. There's going to be a few stories that we went in this. So
stories, I'm a goose.
Yeah, the Michael Saylor is the co-founder and executive chairman of a company called Strategy, formerly MicroStrategy. He's a very big Bitcoin proponent. And from his point of view, He believes that Bitcoin represents the risk-free rate of return. So from his point of view, any other alternative investment must be able to return more than Bitcoin on a risk-adjusted basis. So in his point of view, and I'm paraphrasing a little bit from what he said, but he's basically said, well, if I believe that Bitcoin has a risk-free return of 45% compound annual growth rate a year, then and if somebody was to come to me and say, hey, would you like to invest in my startup? He would need to believe that his returns are going to be greater than 45% a year, because it would be 45% a year plus a risk-adjusted return basis. Now, if, let's just say, for example, that startup had a 50% chance of death and a 50% chance of success, you would apply something like a 50% risk rating on that, and you would say, okay, well, instead of a 45% return, I would need to be very confident that I'm going to get at least 72.5% return on investment. So you get the 50% adjustment on top. Okay.
Yep.
Now, I don't believe that's an appropriate hurdle rate for most people, but that's just Michael Saylor's point of view. And so some people have picked the S&P 500. Yes.
I just wanted to simplify that just quickly.
Sure.
So the way that I kind of like break that down is it's just helping to compare. Again, it's like, what are you setting out to achieve? You as an investor, part of this process is like you're in a situation where you have an option and there are opportunities ahead of you to invest your capital into. And so this is helping you to compare those, because on one hand, like Goose, you said, there are obviously different levels of returns. Like one thing might be claiming that will get you 50% return in a year, but then another thing you might get 10% top line. But each of those things are very different in the risk profile. So you have to adjust those potential returns based on how risky the different assets are, because then that helps you to be more accurate in choosing and comparing the two assets in terms of where you are putting your capital.
Totally. Let's come back to that, because there's a layer to that we need to get to.
Cool.
Okay.
Yep.
So the point is, in the first instance, you have to establish what is your benchmark. What is the thing that you're trying to beat? Now, you get to choose that. And this is why, Gabby, you would like, there must be a formula. It's like, it's this plus this plus. It's like, okay, well, I mean, there is a formula, right? But the first input of the formula is, what are you trying to beat? That's actually the first. Yeah, that's actually the first input in the formula. And that is a very subjective thing. Now, let me give you another little story. So I was talking to this wonderful couple the other day. Their names were Alana and Tom. And they were wanting to get started in property investing and all that kind of stuff. They hadn't invested in property before, but they very proudly told me that they'd had their money in a long-term, high interest savings account, and it had been earning them 5% a year or 6% a year because interest rates have been higher. And so they were like, we're doing great. And I said, well, you know that money's debasing at 10% a year. So you've actually been losing like 4 or 5% a year. And instantly they were just like, what? So from their point of view was that their reference point was 0. So they said anything above 0 is good, right? So anything that is positive is a gain. So once then I reframed the reference point, they actually were able to shift that. So I will talk about how I think about setting a hurdle rate. But the point here is that everyone can choose what their hurdle rate is. And by the way, I'll explain how it changes. Your choice can change how you then think about the assets you need to get to, and how then all of that kind of stuff. So the way that I think about a hurdle rate is I think about what is the rate of monetary debasement. Now, here's some interesting stuff around that. As you've probably heard on this podcast over the last few weeks, on average, the monetary supply in Australia has increased. The monetary base in Australia has increased by 10% a year on average every year since for the last 60 years, right? 10%. In the US, it's about 8% compound, which is interesting. Globally, it's about 12.6%. So that's really interesting. I was listening to the great podcast on this yesterday. It was awesome. That's super interesting, because what that actually says is that the monetary expansion in the US is less than Australia, and also less than the rest of the world. So now that's super interesting, because what that actually points to is the fact that all currencies devalue faster than the US dollar versus the US dollar, and therefore other countries need to print more money faster in order to try and stay ahead. Therefore, the monetary base expands faster as you go further away from premium. So the Australian currency and the Australian economy is kind of like they call it a mid-major, right? So the majors are like US, China, EU, UK, maybe Japan. Japan also could be a mid-major. But then like India, Australia, these are kind of mid-majors, right? So the majors and the mid-majors make up like 90%, but then also you have this like asymmetric expansion of the monetary base. The further you go down the kind of like credibility tree or the strength tree of major economy to minor economy, the monetary base expands wider at the bottom and pushes up the total overall monetary base, which I think is quite interesting. So even in that, you get to choose what is the point of reference that you want for the hurdle rate of monetary debasement to be. Now, for simplicity's sake, let's just say it's 10, right? So let's say monetary debasement is 10%, and you're like, okay, at a bare minimum, I've got to be beating that in order to get ahead. I keep looking at all the chat, and I keep getting distracted. I've got to stop doing that. So you could say at the bare minimum, I want to beat 10% in order to get ahead. Good, fantastic. But then you have to go, okay, so can I invest at 10%? Can I get a 10% return on something risk-free? Because if you could get a 10% return on something risk-free, then you could be happy to, okay, you're debasing by 10%, I can get a 10% risk-free return. Now, then you also need to think about taxes. Now, let's say you've got to pay capital gains tax. Let's say it's non-income based, but you've got to pay capital gains tax on it. Or if it's income based, by the way, you would then also have to factor in income tax expenses. So you would have to add somewhere between 25% and 45% on top of a 10% risk-free rate of return in order to break even with a 10% hurdle rate. Are you tracking? Right. Yep. So if I had something that genuinely could give me a 10% risk-free return, then I would still be making returns on that. And I would still have to. So for example, if I invested in a convertible note or some kind of a bond, right, where the 10% was coming in the form of income, then I would have to pay income tax on that. And I would pay that at a marginal tax rate of somewhere between 30 and 45%. Okay. So then in that case, if it was income derived return, then I would need to achieve not a 10% risk-free return. I would need to achieve a 13.5 or a 14 or a 14.5% return, so that post-tax I was still
end up ahead.
Just treading water against my benchmark of monetary debasement, right?
Yep.
So, and if it was capital gains based, so if it was like, for example, if I'd invested in the S&P 500 and the return was 10% a year or whatever, that's not risk free, but let's say it was capital gains based, then and if you own the asset for more than 12 months, then you're roughly going to be 25%. So you would need to get about 12.5%, which, by the way, interestingly, is right about what the typical hurdle rate is for most funds, most investment funds. Typically about 12 to 12.5% hurdle rate that most people want to get on their money, which is very interesting.
Noted.
Now, that is based on a risk-free return. Now, how many things do you know that you can invest in that are risk-free? I can't think of any, right? So the typical
I could find heaps on the internet.
I bet you could. I bet you could. So, what is often touted as the risk-free rate is US Treasury bonds, 10-year US Treasury bonds typically, right? So, you could superimpose like a 10-year Australian Treasury or whatever, right? But it's typically something like that. But here's the broken piece of that is that is like the least risk-free proposition in the world. Because like a 10-year US Treasury only pays you something like 4.5% interest. And if the monetary debasement is at 10%, then you're 100% guaranteed to be losing money. So to me, that seems like risk to me, right? So the question then is like, what could you invest in that is actually risk-free? And the answer is basically nothing. Like, I don't think there is anything that you can invest in that is risk-free, because the fundamental premise that we don't have a sound money system, the fundamental premise that our money, which is a mechanism to transport our economic energy through time and space, is fundamentally broken, requires us to take our economic energy, seek risk, to expose ourselves to a monetary premium
Mhm.
so that we can outperform the brokenness of the money. That is the nature of why we invest. We're forced by a broken system to seek risk. Okay, so by definition, if the point of reference is broken money and you need to beat the brokenness of the money, by definition, you must seek risk in order to obtain a monetary premium over and above the brokenness of the current monetary system. Okay. So then what you would have to say is like, okay, so I want to beat 10%, but then I'm also going to have to probably pay tax on that. And then also have to calculate risk on that. Now, there's a couple of ways to think about risk, by the way. So one way to think about risk is volatility. So you could say, for example, the S&P 500 has a 15% vol and a 15% ARR. So what does that mean? In recent, over the long term, over 60 years, the average return on the S&P 500 is like 8% or whatever. Like it's about the same as M2 money supply increase in the US. But over the last few years, it's been more like 15%, right? So it's got a 15% ARR, so annual rate of return, growth rate, CAGR. And it also has about a 15% vol, right? Which means that it can go up or down by 15% over any given period. You can have a bad day or a bad week or a bad month, and it can drop by 15%. That's a standard deviation. You can also have non-standard deviations where it goes down by more than 15%. But if we just use standard deviations, you would say that the vol is 15%. So let's just say, just for the point of this example, let's just say that the S&P 500 could deliver you a 10% return. Now, I've just said 15, but let's just work with this example. Let's say that it could give you a 10% return, plus it had 15% volatility, plus then you had to pay taxes on it. So what you would have to do is you would have to say, well, I'm going to invest in the S&P 500, and it's going to give me 10%, but plus I need to allow for the vol, because what happens if I need to sell it at a time when the vol is down? So you need to account for the volatility. So then you would say 10% plus 15% is 11.5%. So then you would add the taxes on top of that. So then you would add another 25% on top of that for capital gains tax, assuming you've held it for more. So then you're getting pretty close again to that sort of 14% mark that you need to beat, right? In order to, and this is to tread water. So then the question is, okay, well, that's the S&P 500. And again, I've just made up some numbers there, by the way. What else might I invest in? And how else might I think about the risk-adjusted return? Sorry, let me speak about the second way to think about risk, which is interesting. The second way to think about risk is opportunity cost. And by the way, there are way more than two ways to think about risk. Let me just be very clear about that. Here are two. One is thinking about volatility, because if you have a highly liquid asset, and if you needed to sell it at a point in time that for whatever reason, circumstances dictated, you need to account for the fact that you might sell it at its lowest point of return. So you might buy it high and then it swings low and then you have to sell it. That's the risk that you put in there. Now, the absolute risk of everything is that everything goes to zero, but that's typically not how you would think about it. The other risk is opportunity cost risk, which is actually something you were talking about just before this. It's a different type of risk, and that comes from illiquidity. So that risk comes from the fact that, let's say you go, okay, I found an investment and I want to put my capital into that investment, and it's going to give me 15% a year, but it's locked up for 2 years. I can't touch it for 2 years. And then 3 weeks after you commit to that investment and your money's all locked up, something else comes along and it's a way better opportunity. It gives you a way better risk-adjusted return and you can't participate in that. Or something goes wrong, something in your life changes and you really need the capital and you can't get it. And because it's locked up and you can't get that capital, you have to start selling the kitchen utensils or something. I don't know, right? Yeah. So this is a different way to think about risk. Illiquidity gives you risk from exposure to the lack of access to capital, but also from an opportunity cost perspective. And so that is actually why liquidity trades at a premium to illiquidity. So if you have something that is going to be locked up with low liquidity, necessarily you should be seeking a higher return, because if you had two options, two assets, one was going to give you both were going to give you a 10% return a year, and one was 100% liquid, you could just take the money out whenever you wanted, and the other one was locked up for 2 years and you couldn't touch it, which one's more valuable? The one where you can take the money out whenever you want, right? Because it's more liquid. So necessarily illiquidity you must get a premium on top of that as well. Okay, so this is another way to think about risk. Go on.
Yeah, just quickly on liquidity. Like in this sense, we're talking about liquidity as the characteristic of how accessible the funds are if you need them, because it's basically how easily could you turn this into cash. That's what liquidity means in that sense.
Correct.
And obviously this is one of the few downsides with real estate, because if you have a bunch of, like, if you put in your deposit to buy a property, that property will grow over time, particularly if you've bought well, but it will grow over time and your equity base will grow. But in order to take that out, you either need to sell the property or you need to refinance, which comes with a barrier in terms of you being able to have the borrowing capacity and get approved for a loan and everything to get that out. So it's not very liquid in that sense.
Correct.
Compared to if it was just cash in the bank. Terrible investment, but you can very easily just go bing, bing, bong, numbers in the bank, take the money out. And so in that comparison, if you are concerned about liquidity, like, real estate is the worst choice in that scenario.
Yes, but right. And so this is actually why it factors in as part of the risk premium, because liquidity or illiquidity in and of itself is not necessarily good or bad. It is how you think about the risk-adjusted return. And the illiquidity of real estate is actually what drives a significant portion of its returns. So the illiquidity makes banks feel very safe, which means they're prepared to give you a lot of leverage on it. Also, the markets don't swing very much. The volatility is very low, which means that you can expand your capital in a very significant way, which is actually how and why. So these kind of like negative characteristics of real estate. Oh, real estate market moves slow. Oh, it's really expensive. It's very hard to get into. Oh, it's highly illiquid. Actually, those things are what actually support a higher risk-adjusted return. Now, you do have to take into consideration your personal situation. Like, are you prepared to have that level of illiquidity in your life? And I think that, in a kind of a diversification sense, it's good to have some liquid and some illiquid, some current assets and some non-current assets. So you've got that kind of optionality. So as we start to then break this down into a bit of a formula, so you can start to think about your hurdle rate, so by the way, all we've established so far is effectively how you need to think about breaking even versus your hurdle rate. Now, in this case, the hurdle rate that I'm nominating is monetary debasement. Pick your own poison. Well, I personally think that's a pretty bloody good one. Now, and I'll reiterate the reason I think it's a good one. The reason I think it's probably the right point of reference is because the only reason you invest is because you're trying to beat the brokenness of money. So to me, that's like the singular point of reference. If you want to choose something else, absolutely fill your boots. So all we've established, go on.
Just quickly on that, like, most people, I think, don't think about trying to beat the monetary debasement rate because they're not aware. So most people, like in the story of Alana and Tom, it's like most people do think that anything better than zero means that they are winning. And so, oh, wow. That's beautiful. I'm winning. Gabby's winning.
You're winning.
I'm winning. Yeah, most people think that anything above zero means that they're winning. And so that is their hurdle rate. And so it's just being able to rethink.
Totally.
What are you trying to cover here? Yeah,
absolutely. So people typically they'll do something like go on an exponential calculator, or they'll make an exponential function in a spreadsheet, and they go, what if I get a 6% compounding annual return a year? Number goes up, the number looks way bigger at the end of the spreadsheet than it looks at the start of the spreadsheet, and they go, oh my god, I can turn $10,000 into $1 million just with all these compounding. Yahoo! Problem is purchasing power has gone down. That $1 million is actually only worth $250,000 by the time you get there. No good.
Yep.
So it's kind of a broken concept, and that's why I think that the monetary debasement should be the correct hurdle rate to work with. Now, again, you could choose. You want to use the US 8%, Australian 10%, global 12.6%. That's your prerogative. But we'll just use 10% for the purpose of this. So back to the agenda, right? So what we've established right now is, in fact, how to think about breaking even. So how to think about breaking even is, what is the monetary debasement rate plus what is the risk-adjusted return of the assets that I'm getting, or what do I need the risk-adjusted return to be in order to be able to beat that, plus the tax considerations, gives you the target hurdle rate that you need to beat. Now, in these examples, we're sort of sitting right around that sort of 14%-ish mark just on that. Then you need to ask yourself, okay, well, if that's treading water, then what do I need to do to get ahead? Because no one wants to tread water. I mean, it's all well and good, right? That it's actually better to preserve your capital than to lose capital. But it's actually even better to make your money make money, which is one of my favorite things to do. Make your money make money. And so then I go, okay, well, okay, let's say it's 14, 15%, right? Just for simplicity's sake. Let's say that is the minimum threshold to just tread water. Then the question would be, well, how much more than that would I consider to be an acceptable minimum return in advance of that, like on top of that, as a gain? How much do I want to grow my wealth at by a minimum? And so that's where I arrive at 20% being the minimum acceptable hurdle rate. So I go, okay, so all things being equal, I probably need to beat about 15% just to tread water, right?
Mm-hmm.
Plus, I would want to make at least 5% a year, at least 5% a year. Now, of course, if you can make 300%, awesome. But again, that's going to be dependent on a couple of factors. It's going to be dependent on the risk-adjusted return. So I actually want to come back to risk-adjusted returns. I think it's a very important topic for us to kind of dig into, because I don't think people understand how to think about this in a meaningful way. But just to kind of complete the formula, right? Your hurdle rate that you want to aim for is equal to, in this case, the rate of monetary debasement plus the risk-adjusted return of the assets you're going to invest in, plus any tax considerations you may have, plus the desired return that you want to grow your wealth by every single year. That then gives you the number. So there we go. We got to your formula, Gabi.
Thank you for the formula. I appreciate it.
Let us know in the chat if that makes sense. Let us know if that formula makes sense. Okay.
Mm-hmm.
So this is why I say 20% should be the target. Now, what's great about having 20% as a target is it's actually not that hard to beat. And the other thing that's great about it is that as markets, move, the day-to-day gyrations of the markets, I have a phrase that I love that rolls around in my mind, because markets are wildly just, they're irrational, beautiful, wonderful, psychotic things. I have a saying that rolls around in my head: the day-to-day gyrations of the market are not of my concern. Whenever I wake up and I see that everything's red, I'm like, the day-to-day gyrations of the market are not of my concern. The question I ask myself is, am I beating my hurdle rate? Now, we've had stuff that's gone up by 300% and then down by 150%, or up by 300%, down by 100%. And it's like, yeah, but if the hurdle rate's 20%, and if I'm measuring me versus me, not me versus some other schmo, like last I checked, winning, right?
Yeah.
And that actually allows you to stay happy, calm, confident, focused. Comparison is the thief of joy. It's you versus you. Are you achieving your goals?
Yep.
Now, we have a minimum acceptable hurdle rate of 20%. We have a target hurdle rate of 40%. Two different things. It's kind of like downside 20% is cool, right? It's good. Really, really what we sort of want to look for is like 40%. That's like the real kind of main objective. And 40% is interesting.
Just quickly, would you call the 20% almost a KPI for our portfolio?
Yeah, I'd call it a KPI for the portfolio. Yeah, if we're not doing at least 20%, then I don't think I'd be managing our money very well, right? So like I would consider that a KPI. So yeah, so I'd say that would be like a minimum performance KPI would be a 20%. And by the way, the way to think about this for everyone who's listening, that is a 20% compound annual return on capital. Okay. So each year, our money should be going up by 20% minimum. The target return is 40%, and then everything above that is cream on top, and just makes you feel good. But that means that I don't need to care what somebody else got. Like, you're always going to miss opportunities, and it also means that I'm not jumping around going, oh, Johnny over there, he's getting this return. Oh, we should sell this stuff, go buy that stuff, because you end up just chasing shiny objects and actually going backwards, not going forwards. So it allows you to have more confidence. And yeah, Braden, is that on invested capital only? Well, it's on total capital. So let's say you started with 100 grand, right, of capital, and you got a 20% return in 1 year, then you would have 120 grand. Okay. The next year you want to get a 20% return on that 120 grand. And so that would compound like that. And so if I think about it on an individual investment basis, let's say I go and buy 100 grand of equities, then I would want that 100 grand to turn into 120 grand at a minimum, by the way, at a minimum. Personally, personally, we tend not to. Well, we have a diversified way to approach investing. So we have some things that are lower return. We have some things that are higher return. Some things that are liquid and some things that are illiquid. So, for example, we have private equity instruments called convertible notes that we've invested in, and they deliver a 20% coupon rate, which is effectively a 20% cash interest rate with a 30% discount rate. So that's effectively a 30 to 50% return per annum. Okay, so that's pretty good. That's one type of instrument. When I look at equities, because of the risk adjusted basis, I don't want to invest in anything that I don't think is going to like 3, 4, or 5x over any sort of like 3 to 5 year period, right? So we have a much higher target. So you have different assets which have got different profiles. Real estate, again, that is a different kettle of fish. Again, you can achieve. I'll continue to bang the drum on this because I think it's the most important thing to understand. You can get 100%. You could invest in Tesla, and Tesla could double, and you can get 100% return. Right? Fantastic. You could invest in real estate, and you could get 100% return in real estate in 12 months as well with way less risk. And then, by the way, you could then leverage that equity out of it and go buy another property, and then all of a sudden you've got infinite returns on your capital. So real estate still provides the best risk-adjusted return out of anything I can see, despite the fact that we invest in tons of different things. Real estate still provides the best risk-adjusted return basis. So let's talk about risk-adjusted return. And sorry, Gabby, I know I'm talking a lot, so feel free to just.
No, I love it.
If you make a noise, I'll shut up. I promise. Right.
If I make a noise, go for it.
Well, I listen to you making a noise, and I'm like, all right, I better stop.
I make a lot of noises, man. You're good.
So let's talk about risk-adjusted return, right? So, because people focus too much on the return. Peter's asked a great question. 20% sounds hard to achieve with that leverage up safely, of course. Yeah, we're going to talk about that in a sec. People look at return, but they don't look at risk, right? Amateur investors, they go, how much money can I make? And that's the basis on which they decide to invest. You made a noise.
I did make a noise. I looked up. I'm like, I'm thinking of something. No, I probably want to do a whole episode on this, right? Because so many people, particularly, again, we're talking about just like people on the internet, which we are one of apparently, but a lot of people in this space will talk about the top level return and don't factor in what was the risk level to get there.
Yeah.
It's similarly, why is it doing this? Similarly, it's like you never hear about like the costs that went into that thing. You hear about the gross return top level, but you don't hear about the net return, which involves the costs that were involved to get there, as well as the level of risk that they took and they hold by achieving that. It's important, I think, to think about it. Like maybe we should do a whole nother episode as well.
Yeah, we can do that. One of my favorite things is watching people talk about commercial properties and they talk about their net returns, but they don't factor in the loan repayments.
Yeah.
They say we got net cash flow of $150,000, but then they don't talk about the fact that the loan repayments were $125,000.
But we've had that for years as well, right? Like people, because we publish all of our results on our website, but whenever someone asks about the yield, obviously the yield is gross, but when we talk about the cash flow and they're like, does that factor in loan repayments? Well, like it factors in everything. Like it's net at the end of the day for you. Whereas a lot of people won't include their loan repayments in like a net cash flow calculation, which is
sorry.
No, it's like, it's not, you could argue that it is accurate, but it's not like helpful for the investor. It's like, you want to know net at the end of the day, what you are getting back.
That's why we shifted our measurement to return on invested capital. Because return on invested capital is actually going to give you the kind of washed out figure of like, well, how much I put in X amount of money and how much, like, what is my return on the money? What are my returns
on that? Yeah.
Yeah. I put in the money. What are my returns on the money? Now let's talk about risk adjusted return. So let me break it down in very, very simple terms. What you want to think about when you're investing is not just what is the upside, but what is the downside? And then what is the probability of that downside? Okay. So let's simplify it. I know you were smiling there, Gabby, because I nearly said the complete phrase. What's the upside? What's the downside? And can I live with the downside? Right. Which is
I love it.
Keith
Cunningham.
Keith Cunningham, which for those of you who are interested, Rich Dad, Poor Dad, Keith Cunningham was actually the rich dad that Robert Kiyosaki based around the book. Go check out Keith Cunningham.
Very smart
super smart dude. Great book. Anyone who's in business should read The Road Less Stupid by Keith Cunningham. It's a fantastic book. So back to the topic at hand. So what's the upside? What's the downside? And can I live with the downside? But in this case, what's the upside and what's the downside and what's the probability? So let's say you've got an opportunity to invest in a company and the upside is 100%. They're like, we can double this company in the next 12 months. We can double the revenue or double the whatever. We're going to increase the value of your shares by 100% in 12 months, right? That's the proposition. But we've got a 50% chance of death and a 50% chance of success. Well, what's your risk adjusted return? 50%.
50. Yeah.
Because you would have to say, okay, so I have a 50% chance of getting to 100%. So then I discount the 100% by 50%. So let's push that out to an extreme. Let's say you found some kind of like meme coin or something on the internet, somebody's launched some kind of weird token, and there's a potential 1,000x return available to you, 10,000x return available to you. But the probability, it's either going to be 100 million x or zero. And in fact, the probability is it's got a 99% chance of failure. Then you would have to discount whatever you think the upside is by 99%. That would then give you the kind of risk adjusted basis on which to consider that. So then you might go, okay, yeah, sure. Maybe I can turn $10,000 into $1 million, but it's also got a 99% chance of failure. Am I comfortable risking $10,000 for a 1% chance of success? Am I comfortable losing $10,000? If it's 99%, I got a 99% chance of losing $10,000, and I got a 1% chance of turning $10,000 into $1 million. Am I prepared to lose the $10,000? Right, I got a 99% chance of losing my $10,000. Right? Am I prepared to make that gamble? And also, if I take whatever that return is and discount it by 99%, what do I get to? Because that's the actual risk-adjusted return. The way to consider that. So thinking about this is really, really important, right? And this is how you start to then analyze assets that are going to be best suited to. And Bex said earlier, what your risk tolerance is, because your risk tolerance is in effect, to what degree are you prepared to risk losing your money? Mm-hmm. That's actually what it is. So in that scenario that I just said, you could take $10,000 and turn it into $1 million, but it might have a 99% chance of failure. It's like, well, I mean, is that within your risk tolerance or not? For me, it's not. For me, that's way not in my risk tolerance. Like, I'm like, no, I wouldn't want to do that. But for some people, they're like, yeah, let's go.
Yeah, which, for example, like I know that we've debated about the risk profile of Bitcoin, right? Because over the long term, probably one of the least risky asset classes that you could choose right now. But there's huge volatility in the short term. And so for a lot of people, they don't have the risk tolerance to choose that asset, which is totally okay. But to your point, Bex, it relates to how comfortable am I? Like, how emotionally ready am I to handle the volatility that's probably going to come? The top level return might look awesome, but it's going to come with a lot of shit. Should I sell? Should I buy more? What should I do? It's going to come with a lot of that. And you need to be conscious of that going into it.
Yeah. Totally. Yeah. And it is
you can sleep at night.
Yeah. Can you sleep at night? So, and it's an interesting point. So, and again, risk is going to be contextualized against your personal situation. Okay. Mm-hmm. Because for me, volatility. So whilst we did factor that into the formula of how to calculate your hurdle rate, volatility to me doesn't equal risk. Volatility equals volatility. Right. And I actually think the volatility is good. I seek volatility, and I've got a real nerdy example of how to increase volatility to get better returns as well. But the reason I can have that point of view is because I can be comfortable that we're not going to be forced sellers in a situation where the volatility swung to the downside. Mm-hmm. That we can sit there and say, you know, it's cool. Like, it's right. It can go up by 70% and down by 70% and whatever. That's fine. It's all good because we're not going to sell it. So it doesn't matter. If you had 100% of your capital in something that had a 70 vol, right? Then your exposure is going to be higher because the proportion of your capital allocated to that volatility is going to matter. And this is where you start to then think about portfolio Sharpe ratios, by the way. So we're getting a little bit tangential here, but this is why the Sharpe ratio of your portfolio matters. Because you might, for example, take something like Bitcoin, which has got a very high vol, right? And a very high ARR. So it's like a 60 vol, 60 ARR, something like that. You can put 5% allocation of your total portfolio into Bitcoin, and that vol and that ARR will actually improve the Sharpe ratio of the rest of your portfolio that has a lower vol. But that might only be because it takes up 5%. And so your Sharpe ratio goes up. Okay, so you've really got to then think about how these things fit into a portfolio-based context. But now we are getting a little bit tangential.
You've been waiting to say Sharpe ratio for a while.
I like Sharpe
Um,
ratio just as
I
much as
know
I
you
like
do.
my momentum oscillator, right? So momentum oscillators and Sharpe ratios all day
Yeah,
long.
such a nerd. I love you. Anyway, no, so I was thinking, like, in that context, like, we are obviously, us personally, further in our investment journey, in terms of like maturity as investors, and more
Yeah,
complex in terms of thinking about the portfolios. And so we have a variety of assets that we're invested in that have different risk profiles. And so your comfortability with investing in something that has higher risk is because, if, shit hit the fan and that asset was down, we would have other options that we could liquidate instead of that one that's maybe in a downswing in terms of its volatility. But I
yeah,
think with a lot of people in the current economy, right, the way that it's set up, it's like we have to take risk in order to make money to at least cover what's going on with losing our purchasing power with monetary debasement. And so I
yeah,
think a lot of people are in that situation when they're going YOLO everything into high risk assets because they feel like they have to. They feel like they have to take risk. And so
yeah.
I'm thinking about how to support those people.
Well, so the first thing I would say is that if you want to get ahead, you have to take risk.
Yeah.
Like that, like fact. You want to get ahead in life, you got to take risk. You want to find someone to love, you've got to take risk. You've got to open yourself up to the vulnerability of potentially being hurt. You want to get a new job, you want to achieve anything in life, you want to climb a mountain, you want to anything that you want to achieve in life necessarily requires that you take risk. All risk creates friction. All risk requires you to get outside of your comfort zone. All risk carries the possibility of failure. And it's facing that failure and walking forward headfirst into it that actually builds us up as individuals, right? And sometimes you lose, so, and that's fine. And the losses actually help you to make better gains in the future. They actually compound to become winning characteristics. Because if you then have exposed yourself to what failure looks like, you have a point of view that other people don't, that actually gives you a competitive advantage to make better decisions in the future. So the thought of loss shouldn't be viewed with fear. It should be viewed with acceptance. You should reasonably accept that A, if you want to get ahead, you have to take risk. And B, if you take risk, sometimes you will experience failure and loss. And that is going to make you a better person, a better investor, a better whatever, because that's how you're going to build on it. And I think that sort of foundational point of view is necessary. Now, the question though is how much risk should you take?
Mm.
And I think that is a very personal question. I think that's not something that I could specifically answer here. But I think if you can start to build a framework in your own mind around how to think about risk, like I was saying, like, oh, cool, this meme coin is going to go up by 100x. What's the probability of failure? 99%. Okay, am I prepared to risk that much money? Yes or no? Like that starts to give you a framework. And then if you've got that framework that sits against your hurdle rate formula, you can then start to decide, okay, like, how do I feel about this? Does this feel, based on my experience, based on my education? This is why education and information is so important. This is why what we're doing
Yeah.
here is so important. It's
Yep.
because you need to be able to develop the mental frameworks, the knowledge, the experience to be able to assess opportunities and to decide whether or not you think they appropriately suit the portfolio of you. And nobody else can do that for you. There's not like, we can't just build a spreadsheet that just says, oh, just invest in that, because everyone's situation is going to be different. Everyone's personal profile is going to be different. And so having that framework of, okay, what am I trying to beat, right? Because if you don't have a framework of what to beat, then you might think that a 6% return a year is good. And you also might think that anything less than 1,000% a year return is bad. You would have no point of reference. So you don't even know where you are on the map of the potential investable universe. If you have the hurdle rate point of reference, and then you establish, again, do your own work. These are just my numbers. But let's say you've established that 20% is the target minimum hurdle rate. Then you have a point of reference to assess things based on that. And if you could go, do I want to buy US treasuries and lose X amount per year? No, that sounds shit. Okay, do I want to invest in a meme coin that's going to give me that could potentially give me 1,000x return, but I could lose everything I invest in it? No, that also sounds kind of shit. Okay, so then you start to narrow down and filter through. And by the way, this is why it's actually important to have a well thought through hurdle rate, because if you just go, you know what, my hurdle rate's going to be 100% a year because I'm just going to crush it. Okay, well, guess what? You've just ruled out most things that you could invest in. on a risk-adjusted basis. Like you've just ruled out most of the stuff. Now, I'm not saying you can't get 100% return. We've done it multiple times, right? They're absolutely fine to get 100% return. But if that is what you're measuring as the minimum acceptable rate, right? You've just ruled out so much opportunity to build wealth. And so what I like to think about is like, what's the minimum effective dose? What is the minimum effective dose to get you to your goals? And that is not to say lower your standards, but that is to say, what is the point at which you can sleep at night knowing that A, you're getting ahead at the rate you should be getting ahead, and B, you're not risking everything, right? And that necessarily probably means having a lower hurdle rate and a slightly lower risk adjusted return that you need to achieve. So, should we shift gears a bit and talk about how to kind of get some of these returns?
Yeah, absolutely. So we're at a point now, hopefully, that we are understanding. If you're not following, let us know as well. But you're thinking of a number potentially that you are thinking you would want to aim for as a minimum. You might have that minimum KPI hurdle rate of say 20%. If you're here live, I'd love to hear what your hurdle rates are, and if you want to share some thinking in why you've set that hurdle rate, would be awesome. So we have that minimum, and then we maybe also have a target of like, this is ultimately like we're shooting for this one. This number here, number one, this is the minimum that I will feel happy with this particular asset returning, and then another target of what I'm shooting for. What I think people would love to hear from you, Goose, is how to approach beating that hurdle rate. Obviously, just factoring in all the different asset classes,
Yeah.
everything happening in the economy right now, everything that you're aware of in terms of different markets.
Yeah.
How can people think about maybe beating their own hurdle rates?
Yeah. Okay. It's a really good question. Okay. So, the way to think about assessing assets, you've got to take into consideration a few different factors: performance and risk, obviously, right? Now, risk in this context has to be viewed in a couple of different dimensions. So let's just take Bitcoin, for example. Okay. And by the way, to the point that somebody else did post earlier, Trump actually did just sign an order to establish a strategic Bitcoin reserve. So that
Wow.
is pretty exciting news.
That's massive.
Although what I can see here is the reserve will be capitalized with Bitcoin owned by the federal government that was forfeited as part of criminal civil asset forfeiture proceedings. So at this stage, they haven't committed to buying any, right? So I think that's why the price hasn't jumped. But it's the start, right? So that's pretty interesting. But anyway, back to the point. Let's just take Bitcoin as an example. And this is not a recommendation to go buy Bitcoin. I'm just going to use it as an example. So let's take Bitcoin as an example. Now, you could look at Bitcoin and you could say, what's the compound annual growth rate of Bitcoin over the last 15 years? And it would be something like 120% compound annual growth rate. Okay, so then do you think that that's an appropriate point of reference for where it's going to go? Do you think it's going to go by 120%? No. The reason it has gone by 120% a year is because it started from such a low base. So then you would go, okay, well, how would I think about what the potential return profile is of this asset over a nearer term time horizon and into the future? So you might look at, say, the last 5 years and go, okay, well, the compound annual growth rate of Bitcoin over the last 5 years has been 50 to 60% compound annual growth rate. Okay. And if I think about that, and then I think about the fact that over 15 years, it's like 120%, what that tells me is the rate of return is gradually slowing. So how might I think about what I believe the return is going to be like in the future? And how would I develop a thesis around that? And this is the same for everything, right? This is the same for Tesla. So if you just look at Tesla, the car company, you would probably say, well, BYD from China is going to outperform Tesla on EV sales. And therefore, as an electric vehicle car company, Tesla is under threat. Fine, all good. But if you took a thesis and said, okay, but Tesla seems to be leading the world in real world AI, and also Optimus is probably got the highest chance of success based on their production capabilities, and the energy business alone is worth probably $1 trillion, then you might develop a different thesis on where the potential is going to go. So you have to form a thesis around why you think something will grow in the future and by how much. Now, in the case of Bitcoin, you may base that on things like adoption and supply curves and all of this kind of stuff. So that would be one point of reference. Then you would have to say something like, what's the volatility and what is the absolute risk of failure, right? And this is a very important thing. So if I look at Bitcoin, I would say the risk of absolute failure, right? The risk of Bitcoin going to zero is, I don't know, like a fraction of 1%. Like it is so minuscule that I'm not even sure that it would register on, and again, in my opinion only, right? But I'm not even sure that it would register as even being a probability. It would be so marginal. Now, is there a chance that it might not grow and all? But what I'm talking about is absolute, like for it to go to zero, like something. It's hard to even imagine what would cause that, right? It's not going to be quantum computing or any of this other bullshit they talk about. But if I think about what is the absolute risk of Tesla, well, I mean, could I imagine a scenario where Elon Musk drops dead? Hope he doesn't, don't want to talk bad about anyone or whatever. But practically, there's probably more chance of that than Bitcoin going to zero. So I have to factor in what is the absolute chance, what's the absolute risk here. So you have to kind of factor these things in. And I might have gotten a little bit off piste, but you wanted to know how I think about finding or think about assessing these opportunities, right?
Yeah. So if everyone set their own personal hurdle rate, like say it's
Yeah.
20%, or they want to get more, how could they approach beating that?
Yeah. So you would look at, so first things first, you would look at what are the things that you're interested in? What are the things that you think are going to get you those kind of returns?
Mhm.
Then you would start to then think about what is the risk. So for example, and also risk is also risk of future return, by the way, because you've got to think about Nvidia. Nvidia's gone up by whatever, a bajillion percent, but is it likely to go up by a bajillion percent again? Probably not. So you've got to factor that into your forward return calculation. And then you've got to decide, and this is where you as an investor need to develop to become an informed, intelligent investor, to decide, okay, based on what my thesis is around this asset, why I think it will go up, and based on what I believe the perceived risks are, do I think that this gives me the appropriate risk-adjusted return? Now, the thing is, you can get these kind of returns in so many ways. People are like, 20%, how are you going to get 20%? 20% is crazy. 40% is wild. Okay, so like you can buy a property, let's say you buy a $500,000 property with a 10% deposit, and let's just, for the point of the discussion, say 10% in costs, okay? So actually 20% in costs. You buy a $500,000 property and it goes up by 10%. You've put in $100,000. It's gone up by 50%. You've got a 50%. It's gone up by 50 grand. You've got a 50% return on invested capital. Bing, bang, bong. The property only had to go up by 10%, and you've made 50% return on invested capital. Now, yes, you would need to factor in selling costs if you wanted to liquidate that. Yes, you'd have to put the 25% of the 50 grand and all of that kind of stuff, but you're still going to be above your hurdle rate, right? If that goes up by 10% again the next year, you're up by 100 grand, you've got 100% return on invested capital.
Yeah.
And so real estate is such a simple and easy way, particularly if you use it to get growth, particularly if you use leverage. Now, leverage needs to be used carefully and cautiously, and you really need to think about how to use that. So, for example, leverage on real estate is, in my opinion, not financial advice, by the way. We're just two bobbleheads on the internet. So use your own judgment. Don't be silly.
You've called me worse things.
So, real estate, I think, is very safe. So I feel very comfortable using debt on that, right?
Yeah.
But by the way, leverage doesn't always mean debt, by the way. Leverage actually means, how do I increase the beta on my capital, right? And there's different ways to do that. So one way is to use debt. Okay. And everyone's very familiar with that. Okay. I put in, just in that example, you put in $50,000 deposit and $100,000 of cost, but you're really getting leverage on the $50,000, so you're using debt as a way to increase the beta, increase the returns on your capital. Now, beta is really a measurement of how much the underlying or intrinsic value or the capital that you put into an asset moves relative to the actual asset price movement. Okay. So in this case, let's just simplify that down, and I'll try and simplify this down a little bit. So let's say you buy a $500,000 property and you put in a $50,000 deposit. Let's just say you put in a $100,000 deposit, right? Forget about the cost. It's $100,000 deposit, right? And then the property price goes up by 10%, right? It's gone up by 50. So it's gone up by 10%, but your return on capital has gone up by 50%. So that would be a 5 beta. right? So for every percentage point that it goes up, your return goes up by 5 effectively, right? So that's effectively how to think about that. Now, so real estate is actually one of the easiest, best, safest ways to get the highest risk adjusted return. I've got another real complex one to talk about as well, but go, you made a noise.
I did make a noise. What came to mind then was actually about, like, you're talking obviously financial leverage in terms of debt and loans and everything for real estate, but it can also come in time and investing. So for example, like our services, paying someone like Dashdot to be able to get you into assets that grow in the way that they do to end up with that net result for you is a very good investment in terms of like paying somebody for a service if they're going to help you to get a better return, right? That's another way to think about leverage.
Yeah, absolutely. Yeah, leverage can come in a whole bunch of different ways, right? So, but it's not. Yeah, my point is that it's not always debt, right? So,
Yeah.
let's say you wanted to take the S&P 500. Is everyone ready for like a weirdly complex, highly convoluted way to achieve a high beta, high return? Okay, great. I'm going to do it
Yes, we're ready.
anyway.
I feel like I need a seatbelt. Should I get a seatbelt?
Yeah, I'm going to talk about some nerdy shit. So,
Great.
so let's
Lindsay's
say you
into
take
it. Let's go.
Yeah, Lindsay's into it. Lindsay's into it. Lindsay loves it. He loves it. He loves it. So let's say you take the S&P 500. Now, one way to get leverage without using debt. So here, right, you could get debt, right, and you could get a margin loan on the S&P 500. Now, you could get a margin loan on the S&P 500, and then you could use that as leverage. So you could get, I don't know, 50% LVR margin loan, and then if it drops by 25%, then your margin loan is going to get called in, and all your shit's going to get liquidated, and you lose all your money, basically, right? That's a pretty risky way to get leverage. And so on high volatility assets, debt as a leverage instrument can be really risky because you run the risk of it being called in. Now, I'm going to sidestep a little bit, and I'm going to come back to the weird convoluted way to get a high return out of the S&P. But strategy, formerly MicroStrategy, they use convertible bonds to get leverage. And so people hear leverage and they think, oh my God, MicroStrategy has lots of debt. Well, in fact, they don't have debt. They have convertible bonds, and they are different. And so in that context, what is happening is the bonds can convert into equity at a future point in time, but they're actually getting an application effect from the leverage. There's no call out mechanism, basically, right? No one can come to them and say, we're calling in the loan, liquidate your shit and give us our money back, because that is not the way the mechanism is structured. They get the leverage as if it were debt, because it's a debt-like instrument, but it has no margin calling aspect. So they can't get their debt called in and be forced to liquidate their assets, right? Even if Bitcoin were to fall to $6,000, they would just issue more shares. So it's an equity risk and not a capital risk. Okay. And the point that I'm making there is that debt is not the only way to get leverage. So let me talk to you about a weird, convoluted other way to get a higher leverage return out of something like the S&P, which, by the way, if you just invest in the S&P, you are not going to beat your hurdle rate. If your hurdle rate is monetary debasement plus taxes plus risk adjusted return, you won't. Yep. Because the S&P 500 broadly tracks M2 money supply in the US. So the average over the long term, over 60 years, is about 8%. In recent times, about 15%. But basically, however much the S&P 500 is going up on average over a year, that's about how much the M2 money supply increased in the US. So as soon as you sell it, you pay taxes, you're behind, plus you haven't accounted for the volatility. So you basically can't get ahead by investing in the S&P 500. But what if you could? There are a thing called options, okay? Now, when some people hear options, they think about like people day trading options and clicking buttons and 5 computer screens. And I'm not talking about any of that shit, because that's mad and that's heaps risky and you can lose heaps of money, right? What an option is the right to buy a security at a predetermined price at a specified time in the future. Specifically, a call option is the right to buy a security or an asset or whatever the subject is at a predetermined price at a specified time in the future. Okay. So one way you can get leverage on something like the S&P 500 is to use a strategy called leaps. long-term equity appreciation securities. It's a bit of a butchered acronym, but that's what it is. If anyone who spells that out is going to realize those letters don't match up with the first letters. Long-term equity appreciation securities. So you could, for example, purchase an option on a contract for 100 S&P 500 shares or SPY using the SPY index, and you could get leverage on that. And I'll break it down and I'll explain it to you because this is really interesting. And in fact, leaps and long-term options has actually been one of the best ways outside of real estate that we've actually found to expand, to get significantly higher returns. This is where you can get triple-digit returns, but it increases volatility. So let me explain this, and this is not for do your own research, right? But just let me explain the concept because it's really interesting, and it was actually a big unlock. It still doesn't beat real estate in Australia because you can get infinite returns in real estate in Australia, but using leap options is pretty interesting. So what you do when you buy one options contract is you are securing the right to buy 100 of the underlying shares at a predetermined price at a specified time in the future. So I prepared an example. Let me walk you through the example. Unfortunately, I don't have a visual that I can share because I did have to scratch this down in a kind of unstructured fashion. But let's say one share in the SPY index, the SPDR S&P 500 SPY index is currently trading at $572.71 today. It's about what it is. If you buy an option, there's a question of, are these puts? No, call options, specifically call options. I don't really know anything about puts, and they scare me because the reason they scare me is because the reason they scare me, and it's the same reason I don't like margin loans, is because someone can force you to do something. Yeah, I don't ever want to get into a position where someone can force me to do something. And people can force you to do stuff. So puts can be a little bit risky, right? So specifically call options, and they're long-term call options. So when you think about leaps, the expiry date should be at least 12 months out. And I can get into theta and time decay if you guys really want me to get really nerdy on it, but maybe I'll stray away from that for now. So I did an analysis on a specific scenario so that I could give you guys this point of reference. So let me walk you through the scenario. So today's date is Friday, 7th of March, 2025. If I was to buy one option contract on the SPY at a strike price of $550 with an expiry of June 18th, 2026. So that's about 15 months away into the future. Okay. So I buy the option contract today, and the expiry would be June 18th, 2026. The current share price is $572. The strike price that I would buy would be $550. In this example, I'm not saying I would do this, but I'm just giving you this example. The strike price in this scenario is $550. So that is termed in the money, or actually it's near the money because it's actually only just a little bit less than the current share price. So the strike price would be $550. The premium that I would pay to secure the right to buy SPY shares at $500 by June 18th would be $75 per share. So I would pay $75 times $100 equals $7,500. So I would pay $7,500 for the right to buy 100 shares of the S&P 500, 100% shares of the SPY index by June 18th, 2026. So in principle, if I wanted to exercise that option and buy the shares at the end, two things would need to be true. Number one, the share price would have to go 550 plus 75. So the share price would have to go to $625 plus taxes in order for me to theoretically break even. Okay. Plus, then I would also need to come up with $55,000 in order to buy the shares at the end of the day. But here's the thing. You don't actually need to exercise the option. You don't actually have to buy the options in order to exercise them. You can just secure the right in the future. So using this, a $7,500 purchase price to buy one contract of 100 SPY shares, what that would actually give me is an option premium ratio of 550 divided by 7. Sorry, my keyboard's broken. 550 divided by 75. The option premium ratio would be, sorry guys, I broke my presentation. 75. What is 75 divided by 550? So the option premium ratio would be 13%, right? And the implied leverage or the beta that I would get on that would be 5.07x. So what that would mean is that for every 1% increase in the SPY, you could reasonably expect the value of your options contract to increase by 5.07%. So you effectively got 5x leverage. Now, here's the thing. That's 5x leverage up and 5x leverage down. So if the S&P, if the SPY goes up by 1%, the value of your option contract is going to go up by 5%. If the SPY goes down by 1%, your option contract is going to go, the value of contract is going to go down by 5%. But you've effectively gotten leverage on that, and no one can call you out. The worst case scenario is you can expire worthless. Let's say the option, let's say it just crashes and it goes down. Then yeah, sure, you could expire worthless. So there's an element of risk. But what's the probability that in the next 15 months, the S&P is going to be lower than it is today? It's pretty low. And so in this context, you can very easily take something that's going to give you, in this case, let's just say the S&P is going to give you a 10% return. If you've got a 5 beta on it, you can get 50% return on that on the same underlying stable asset, effectively stable asset. So you've taken something that is low volatility, low risk, high stability. You've increased the leverage component of it in a way that you can't get called out on it. No one is going to call you out on a loan. No one's going to force liquidate your assets to get it. And what you've done is you've increased the volatility. I said earlier that I love volatility because volatility, as long as it's upside biased, upside biased volatility, that's actually going to be better for you. And this is actually kind of the whole point with MicroStrategy is it basically has got beta on top of Bitcoin. It basically goes up more than Bitcoin and then down more than Bitcoin. Hey, Charlie, nice to see you.
Hey, Charlie.
You're looking great too, by the way.
You are looking great, actually.
Yeah, I saw those guns. And so the reason I bring this up, and that may have sounded really convoluted to a whole bunch of people, but the reason I bring this up is actually to highlight the fact that there are way more ways to achieve returns than we take on face value. We just go, oh, well, what are my options? I'm going to buy property, or I'm just going to take. But there's actually creative ways we can think about this. And thinking about what is the beta that you can get on something, how do you get leverage, how do you use leverage effectively to increase your returns is actually super effective. So I like to think about how do I increase volatility in proportion to the rest of the portfolio. Now, do I think you should go and put all of your money into something like this? No, because if you've got 100% of your asset exposure to something that's got higher volatility, then you're increasing your overall portfolio risk and your Sharpe ratio may in fact go down. But this is a way that I think this is a really interesting case study of how you can take something like the SPY, which fundamentally, if you just bought the SPY, you would be losing money, not making money. And you can turn that from, effectively net negative, not meeting your hurdle rate, to then beating your hurdle rate by potentially 30%. Did that all make sense?
It did. I'm trying to think through, what are the potential risks here? Where could this go wrong?
So in this case study example, right? So again, I'm not advocating that everyone just goes out and just does this crazy. You're going to go do some study. There's a whole bunch of complexity to it. But just in this use case example, let's say that you did do that. Let's say you went and bought a call option with a $5.50 strike price and a $75 premium, right? You've got a $7,500 cost exposure. Okay. The worst case scenario is you hold it until its expiry date and the share price is 0 at the expiry date, right? Because as you get to the expiry date, what happens? So the way to think about options is you get access to all of the potential of everything that can happen to that underlying security between the time you buy it and the time that it expires. So when you're a long way from the date, well, I mean, it could go anywhere. I mean, it could go up by a long way and it could go down. So you have this expansiveness of potential. And as you get closer to the day that it expires, it just reverts effectively to its intrinsic value. So the day before it expires, the option value is basically just going to be whatever the share price is, right? Because there's not really much room for something crazy to happen. And so all of the potential is kind of taken out of it and it reverts back to the intrinsic value. So if that intrinsic value at the time is 0, right, then your option expires worthless. Or more specifically, you could convert it at a loss, right? Would be the way to think about it. Let's say the share price is $572 today, and let's say it was $500 in June 18th, when 2026, when it expires. I mean, yeah, you could convert your options, but you'd be converting at a loss, right? So in effect, you would just let the option expire worthless. In that case, you would have lost your $7,500, right? There'd be no value in you converting and saying, I'm going to pay $550 for something that's worth $500. So you would just let your option expire worthless, right? So the risk is the total capital risk that you put in is that could go to zero if the share price is worth less than the strike price at the time of expiry. That's the downside risk.
Yep.
That's about it. Right. And so that's about it.
Yeah. No, and I guess so that in that example, that's if you chose the S&P 500, but if the other obvious risks is if you're choosing the wrong asset to invest in and do that strategy with a different
it's the same risk. It's the same risk,
Yeah.
right? So let's say you pick something else. Let's say you pick something like Tesla, which has got way higher volatility. The risk is if at the point of option expiry, the share price is lower than your strike price, or in fact, you would want it to be, it would have to be lower than the strike price plus the premium, because that's kind of your break-even price. Or if it's less than, even if it's just less than the strike price, then you would let your option expire worthless, right? So you're only ever fully exposed to a 100% loss of capital if the share price at the time in the future is less than it is today. That's why long-term, it's very hard to predict what price is going to do in the short term. It's actually a lot easier to predict what things are going to do over the medium term. You know, is it reasonable to expect, and I have a whole kind of formula around this. I calculate what's the ARR that it has to achieve in order to get to what I believe would be an exit point in a certain amount of time. And typically, you know, you take whatever it grows by, cut it by whatever it's grown by over the last few years, cut it in half, expect less. And then if it still makes sense, go for it. But the point, the sort of the broader point here is, yeah, you could lose all your money, right? But also the total exposure can be a lot lower and you can get a higher return. You're not going to end up with less than zero, right? So you can't get over leveraged and lose anything more than you originally put in. The maximum loss is 100% of your capital. But you can expand the beta on something that carries a lot less risk in the same way that you do with real estate, by the way, where you take something that fundamentally has not a lot of risk and fundamentally moves really slow. The average compound annual growth rate of real estate in Australia is 8%, 8.25%. Okay, well, that kind of sucks. Like, no one wants to get 8.25%. You know what we'll do? We'll use leverage. In this case, it's debt, right? Because you can't option, you can option properties, but it's not the same. So you use debt to increase the leverage. The leverage gives you the return. This is another way to take something that you can go. So you can do this with the QQQ, which has got a better return. And it's got a higher volatility, but a slightly better return. You can pick something that you believe really strongly in. So, for example, I'm a big believer in Tesla. Great. We own Tesla spot equity and also Tesla options, but they're long term, because it's like we're like in 2 years' time, do we think the price is going to be higher than today? It's like it's not rocket surgery. So this is how to think about that. But back to your point, though, everything carries risk.
Yeah. So I don't know where you're wanting to go with this next, but what's come to mind is, how would you think about this type of option compared to investing in Australian real estate? So I'm thinking, like, if somebody's got $100,000 or they've got equity in the properties that have grown and they're thinking about buying another property, how would you think through, do I buy another property or do I do this kind of a strategy?
Well, so let me kind of like break down a hierarchy of how I would think about it. This is me. This is not financial advice for you. This is how I would think about it. Top of the list for the best risk-adjusted return is Australian residential real estate. That's top of the list. So that's number one. So if you can do that, you should do that, because that's going to give you the best risk-adjusted return. That's going to give you the best ability to amplify and expand your capital over a couple of years. You effectively end up with an infinite return. It's crazy. Like, the financial jiu-jitsu you can do with Australian real estate, it's wild. Okay, so top of the list is Australian residential real estate. Second, for me, again, personal choice, would be Bitcoin. And again, these things should then also indicate the proportionality that they take up in your portfolio, by the way, because you shouldn't have everything of equal proportion. If something is better, you should have more of it, right? So it's pretty simple. So real estate, Australian residential real estate, then something like Bitcoin, then something like technology, stocks or technology securities. So that also can include cryptocurrency projects, which specifically are more like tokenized securities and technology projects that blockchain-based technology projects that have utility value. So you might put that in the same. You might put Solana in the same category as Tesla in that context.
Yeah,
And
something
then,
that's helping to build the future, right? That's how
yeah,
I think about it.
exactly.
Yeah.
Yeah, it's also more speculative. It's much riskier. There's a high, startups have a lot of failure, businesses have failure. Like the risk as the risk goes up, the allocation should go down, right? Your expected returns should go up, but your risk should go up as well. So your risk adjusted, so you should have less exposure. You should go in an arc, like in a kind of a funnel like this. And then options should play a role sort of after that fact. That's how I would think about it. I was talking to someone the other day, and I was definitely not giving them unlicensed financial advice. But they were asking me how they should think about, they had a bunch of capital, and I was saying, like if you were me, what would you do with it? Now, in their situation, it was pretty simple. There was three categories. One was Australian residential real estate. So we carved out a portion for that. We said, do that. And then, but their circumstances dictated that they could only have a limited exposure. I won't go into why, but there was a very specific limit. And in fact, they had a couple of properties, but they're actually not in a position to buy any more. It's, they moved countries and stuff. And so they're not actually able to buy any more. So I was like, okay, great. So you've got the Australian residential real estate portion and you actually can't buy any more. Okay. So then you're left with two other options. And I said to this individual, because they are particularly low risk, I said Bitcoin and the QQQ, because I think the QQQ gives you a better optionality than it kind of gives you technology exposure without having to pick individual technology stocks. So then it was basically Australian residential real estate, Bitcoin, and the QQQ. And then I said, then there's another way on top of that you could add beta if you wanted to expand the returns on that, and that would be to do options on the QQQ. So it was pretty much that simple. And for those of you who don't know what the QQQ is an index like the SPY. The SPY tracks the S&P 500, and the QQQ tracks the NASDAQ 100. And so it's not just technology. Like Pepsi is also in the NASDAQ 100, but it does give you more technology-like exposure. So, and without you have to pick the individual stocks.
So again, with this example, like if somebody's got $100,000,
yeah,
understanding that your personal kind of hierarchy there is like the strongest asset type would be real estate, but maybe they're already exposed. Maybe they already have a couple of properties. What are some of the things to factor in terms of, should I buy another property or should I do a lead option strategy? Or
well, I'll say it again. If you are in a position to continue to buy Australian residential real estate, you should probably consider doing that.
Yeah.
Diversification is good, right? But if you have a winning strategy, then
that's a good point. Yeah.
What are you trying to do? Now, do I believe fundamentally that most people should have again, my beliefs are not your beliefs, and I'm not dictating what to do. But do I personally believe that everyone should have some exposure to Bitcoin? Yes. Do I necessarily believe that everyone should have some exposure to technology stocks? No, I don't. I think me personally, I absolutely do, but I don't think everyone should. But I think if you wanted to have some kind of index fund exposure, then a QQQ would be good. Now, Charlie's put something great in here. What about TQQQ, the leveraged ETF? Now, the reason I don't like leveraged ETFs versus options is because the fees eat you up. So the leveraged ETFs tend to have higher fees, and that corrodes the returns. Whereas personally, and this is a personal preference, if I wanted to get higher beta exposure on the QQQ, what I would do is I would go seek an option strategy. I would look for something that is somewhere near the money, and I would do the calculations on it to work out where I could get something like a 4 to 5x beta on the QQQ, and I would do that. That would give me a better return profile than the leverage ETF, and I wouldn't have to worry about the fees, and I wouldn't have to worry about the volatility. It's a different kind of volatility exposure that you would get because of the way they apply leverage in there. So yeah, that's how I think about that.
Cool. Goose, we have 5 minutes left.
Cool. Got any questions we want to cover off? Do you think it's been good? We've covered a lot of ground here.
We've covered so much. Yeah.
Certainly got the waffle on. A little bit of waffle. If you've got any questions, let us know. Let us know in the chat, and we can kind of go through them. Perfect. We've got a few. Okay, let us know if you think this has been useful, if you've gotten something out of this. Has this kind of opened up your mind to thinking about new ideas? Let us know if this has helped you to think about how to define your own hurdle rates, and also then thinking about different ways to beat those hurdle rates, because everyone thinks that 20% is hard to get. It's like, well, it's not. I promise you it's not. You can get it in real estate. You can get it in Bitcoin. You can get it in technology stocks. You don't have to go and become a stock picker. You could literally just buy the QQQ. The average compound annual growth rate of the QQQ over the last 10 years has been about 20%. So you could just buy the QQQ. You could buy the QQQ plus you could do an option strategy on it. So Jerry Varghese asked my outlook for the Melbourne market, please. Hurdle is to know time to buy. Well, I will give you an answer on that. I'll give you a calculated answer on that. So our belief as a company is that Victoria has started to become an opportune time to buy again. We believe that strongly. Now, the Melbourne market is very big. Greater Melbourne incorporates a very large number of suburbs. And so it's impossible and irresponsible to say, Melbourne is good, go buy in Melbourne, because you could still very easily go and make a mistake if you buy in the wrong suburb. So as a company, we are buying in very selective suburbs in Melbourne. And it is very important that you don't just take a broadacre view to Melbourne and go, well, it's all Melbourne, so I'll just buy in Melbourne. That's not going to do you good. Okay. You have to be selective, and you have to understand why different suburbs are going to be driven in different ways. So we do have exposure to the Melbourne market at the moment, and we also have exposure to other parts of Victoria. And we think that does actually represent an interesting opportunity to buy. I won't mention specific suburbs just because it's not fair to our clients who we're actively buying in those places. What I will say, though, is that certain parts of Melbourne and certain parts of Victoria now represent a very interesting time to buy. And for our clients, we are getting into some very interesting places where there's very little competition right now. And yeah, it's an exciting proposition. But I will caution you once again to take that advice carefully, because if you just take that advice as let's go, let's buy, you could still end up buying in the wrong property in the wrong place at the wrong time, and you could put yourself back. So you do need to be careful about it. Blake, if AUD is debasing faster than USD, wouldn't that encourage moving into USD, US markets? Yeah, I mean, it does. Absolutely. That's in fact, by the way, why there's been something like a 10-year, don't quote me on that, but there's something like a 10-year secular uptrend in the Dixie, which is the value of the US dollar versus other currencies. That is because capital moves to the US. So that is also why the US capital markets, stock market, etc., are way stronger than, say, the Australian stock market or the Thai stock market. It's because capital moves to the US because it is a stronger currency. So absolutely, it does. Now, here's the differentiation. Okay, so as I think about this, there's a hierarchy. There's a hierarchy of affairs. If you think about currencies, if you think about political currencies, the US dollar is the best horse in the glue factory. It's the best dirty shirt in the laundry. It is the nicest smelling turd. Okay, it's still shit, right? And so, do you like that one, Gabby? Right? So it is like the US dollar in and of itself is better than the other stuff, but it's still not good. Okay, so take that into consideration. But then, because it is the best of a bad bunch, capital flows more aggressively into the US dollar and into US capital markets, which actually supports a stronger equities market and a stronger capital market in the US. So that's why it's actually better to invest in US capital markets. That's why foreign companies often list in the US, because it's better for them, higher valuations, more liquidity, more access to capital, all of that kind of stuff. Comparing the Australian capital markets and the US capital markets, it's like chalk and cheese, right? This, like, with all due respect to anyone involved in Australian capital markets, it's a capital markets backwater. It is absolutely, it's like, it feels like going back in time to, like, I don't know, colonial South Africa. It's like, well, look, what is going on here? It's mad, right? It's completely mad. So as I think about it, the US equity markets are better because the US dollar is, the best horse in the glue factory. I won't use the turd analogy again, but the best horse in the glue factory. And but that being said, the Australian residential real estate market is, in my strong opinion, and believe me, we've looked in all kinds of international markets, going, oh, geez, I wonder if there's other interesting opportunities, because of curiosity, just because it's like, oh, I wonder if, like, at one point I was trying to convince Gabby that we should buy a property in Ghana, by the way.
True story.
True story.
True
I was like,
story.
oh, Ghana's going to go off. By the way, it did go off, but that's not the point. So
Risk adjusted return.
So the Australian residential real estate market is, in my strong opinion, by far and away the single best real estate market on the planet. I will also say the US equity market is by far and away the best equity market, capital market on the planet. And it's okay to kind of have these kind of things and go, okay, well, where is the best stuff? Guess what? Like, the best pizzas come from Italy. You know what I mean? It's like, it's fine for these things to be true. So I hope that answers that question and how to kind of think about the differentiation between those things. You also got to remember that Australia is a net importer of capital. So what that means is that as global liquidity and other stuff increases, money flows into Australia, but it also primarily flows into the Australian real estate market. So as the monetary base expands, and even as all of this kind of gyrations happen, money does flow into Australia and flow into the Australian residential real estate market as well. So anyway,
awesome,
cool. We have got to wrap.
We do have to wrap it. We have covered so much. I'm actually really happy with how this episode turned out, Goose, because
that's good.
I think there's so much meat in there. Again, going back to the start of why I wanted to do this episode was, like, I want to try and help reduce FOMO and reduce that emotional stress when volatility happens, when prices go up, depending on what you're invested in. Don't get freaked out. So if it has helped you, I would love to hear from you in the chat or leave a comment or something. I would love to know that this is valuable. Also, if you know someone that you think this would be valuable for, potentially someone who has not been thinking about investment as a necessary thing that they need to do, maybe they're thinking, like, as long as I beat 0% and invest in something, then I'm winning, which, as we've covered, is probably not the right way to think about it. Do share this episode with them. There's just a share button on the YouTube video. Just grab that and send it to whoever you think will get value from it, because this is really why we're doing this. We really want to be able to create this, build everyone's education, spread the word, to be able to show them that things are changing and you really kind of need to take action so that you can at least stay ahead, as well as then achieving your goals on top of that. So I would love everyone to share it, please.
Awesome.
Cool. Awesome.
Thanks, team.
That's all.
See you next week.
Thanks all. Bye.